Describe purposes of and controversies related to derivative markets. Historically, derivatives were introduced into the US to improve the state of trade in agricultural products. Because products were delivered based on production, prices would swing wildly from times of overavailability to times of scarcity, and it also put a massive strain on the storage facilities available in the commercial center. The introduction of derivative contracts brought into play a more efficient manner of timing transactions, so that producers were tied to buyers during production, and products were going directly to their point of use rather than a marketplace. Risk management is a very major part of the derivatives market. The key here is the ability to move a risk exposure without trading in the underlying asset. The ability to do this totally revolutionized risk management, reducing transaction costs, reducing administrative burden, and allowing an asset holder to temporarily halt their exposure to a certain type of risk without having to sell a potentially scarce asset. The efficiency of the whole game was improved. Another major benefit of the derivatives market is price discovery. Although some market participants believe that futures prices are an explicit indication of the price an asset will go to in the future, this is not strictly correct, although futures do provide some information about the future. One major reason for this is because capital can move a little bit more quickly in a derivatives market. In a similar vein, options contracts can be used to gauge the implied volatility of an underlying asset. This kind of information can be used to make investment decisions on the spot market, but it requires an active derivatives market to be reliable. One final benefit of the derivatives market is the operational and administrative efficiencies to the investor. Rather than going into the spot market and tying up a large amount of capital, diversifying across equities, we can enter the derivatives market and invest in index futures. Rather than borrowing stock and paying stock loan fees to a broker, we can much more easily take a short position using a derivatives contract. These types of benefit all stem from the fact that trading in the derivatives market is all about risk exposure without having to trade the underlying. Okay, so we have looked at some of the benefits or uses of a derivative market, but we must also be aware of the criticisms of such a market. First, derivative markets are often likened to the legalization of gambling. Although derivatives are used primarily as a tool to mitigate or transfer risk, they are also used by speculators to take on risk. The practice of speculative trading in derivative instruments with little care for the underlying asset or company has given the industry a poor image, with this trading seen as a form of uncontrolled gambling. This kind of accusation is somewhat unsteady though, seeing as there is plenty of equity trading that goes on with the same profit-chasing, gambling mentality. The second major criticism of derivative markets is the excessive use of leverage and excessive consequences of default within derivative transactions. Now, this argument is not without foundation. When a company is over-leveraged and their chosen event does not materialize, they may default on their obligations. It is possible for this first default to lead to a domino effect, with many overlapping defaults leading to a global economic event. The final major criticism we're going to discuss here is the relative complexity of some derivative instruments and pricing models. The accurate pricing of risk is a very heated topic at the moment in a post-global crash economy. By allowing the system to depend on pricing models which are too complex to be fully understood by those employed to interpret and utilize them, misuse will lead to unreliability and inconsistency. If the machine tells you to buy, do you just buy? Or do you really understand why the machine is making that choice? Explain arbitrage and the role it plays in determining prices and promoting market efficiency. Arbitrage is a term used to describe the availability of a riskless profit for someone who can buy at one price and sell at a different price at exactly the same time. If a market is functioning correctly, has low costs, and allows for the free flow of information, one asset cannot be valued at more than one price. This is called the law of one price. If the law of one price is violated, then we would be able to buy a security for one price while simultaneously selling at a higher price. By placing this arbitrage trade, we have no risk exposure to the asset and we earn a profit. In practice, this kind of trade is quickly found by market specialists who immediately act to take advantage of the opportunity. The actions of market arbitrageurs quickly eliminates these price discrepancies. When we combine a derivative instrument with its underlying such that our risk exposure has been eliminated, we have built a hedge portfolio. No matter what the underlying is or what kind of derivative we are using, the return of any hedge portfolio will be the risk-free rate. Now be careful here. I'm not saying that any combination of derivative with its underlying will automatically eliminate risk and earn the risk-free rate. Only a hedge portfolio, which has been specifically constructed to combine the two assets and eliminate the risk, will earn the risk-free rate. To prove this concept, imagine we have built a hedge portfolio. We have some hesitation about the upcoming performance of an asset we hold, so we have decided to temporarily eliminate the risk exposure to it using a derivative instrument. The stock is currently worth $20, and we have entered into a forward contract whereby we agree to deliver one share in 1 year's time in return for $23. Let's say that at the end of the period, the stock has risen to $26. That means we have made a $6 gain on the stock, but now we have to buy a $26 share in the market and deliver it against the forward in return for $23. So on the forward, we've lost $3. The net for this scenario is a $3 gain. What about if the stock price falls from $20 to $15? In this case, we have lost $5 on our equity position, but now we can go into the market, buy a share for $15 and deliver it against the forward in return for $23, meaning on the forward position, we earn $8. Again, the net result is a $3 gain. No matter what happens to the stock, this position is fully hedged and we are guaranteed a $3 gain. This $3 gain is the risk-free rate. Imagine we were to borrow the $20 to start this trade when the risk-free rate is set in the market at 6%. We use the $20 to buy the stock and it costs us nothing today to agree the $23 forward price. At the end of the year, we deliver the stock against the forward and receive $23 in return. The new price of the stock doesn't matter since we are using the original share we bought at the start of the year to fulfill our end of the forward. Now, of the $23 we have received, we owe the $20 in principal to the lender. And we also owe interest in the amount of $20 times the rate of 6% over the course of 1 year, which is $3, leaving us with net zero. If we borrow at the risk-free rate, we will end up with nothing because a hedge portfolio will earn exactly the risk-free rate and nothing more.